Good afternoon and welcome to Santander Asset Management's latest podcast. I'm joined by Stefano Amato, who's the head of our tactical asset allocation and systematic research. Good afternoon, Stefano.
Oh, hi, Simon. Good afternoon.
Stefano, as we've done with previous podcasts, we're just going to go through a series of questions. My first question to you today is, do you believe the investment markets are being overly pessimistic about the impacts of the current program of restrictions in China?
It's a great question, Simon, and it is very much top of mind for a number of investors. Are the markets being overly pessimistic? No, I would say not overly pessimistic. I mean, this is something that we as market participants have been aware of for quite a while. And by this, I mean, the Chinese government's stance towards COVID, essentially, pursuing a zero COVID policy. So there isn't much new in terms of the policy. I think what perhaps might sound new to some investors is, of course, the news of lockdowns. But I think since the dawn of Omicron late last year, if you listen to people who have studied this for decades and do this for a living, the chances of avoiding COVID completely were, slim to none, even for a country implementing a zero COVID policy. That doesn't mean that, people should go out and party like it's 1999 or not wear masks. That's a different consideration. But it was, I would say, expected that this might happen in China and that we might have restrictions. I think the impact, first and foremost, is for Chinese assets, of course, which do form a reasonably important part in terms of weight of global indices, both for equities and bonds. But also I think there are some second-order effects. There are hundreds. At last count, I think it was more than 400 container ships just basically waiting in queue off the coast of Shanghai, waiting to be able to go and unload the goods and reload and go elsewhere. That queue might be cleared, quote unquote, just in time for the holiday season. So it might create further disruptions later in the year.
Thanks, Stefano. The impact of the restrictions in China and obviously the kind of knock-on effects to the supply chains in particular, in shipping and distributing goods. Is this one of the main reasons for the International Monetary Fund recently downgrading their global growth forecasts for the remainder of this year?
Yes, I think it is one of the main reasons, not the only one. Clearly, conflict in Ukraine, Russia's invasion of Ukraine, presents a risk. I do respect, the enormous difficulty of doing the job of an economic forecaster. It's extremely difficult in quote unquote normal times. I think it's even more difficult over the last couple of years. So we do take those forecasts with a pinch of salt, but it's clear that the phenomena that I just mentioned increase downside risks. And I think markets have reacted and are reacting to that.
Thanks, Stefano. Last week on Friday, the Chairman of the Federal Reserve, Jerome Powell, was on a panel for the International Monetary Fund, being interviewed by CNBC. And his language that he used regarding future interest rate hikes was deemed quite hawkish by the markets and saw markets fall on Friday. Do you think that given the economic forecasts are being downgraded and that growth appears to be slowing, that the Federal Reserve may be forced to rethink their rate rises over the coming year?
I watched the interview, and yes, Powell channeled his inner Paul Volcker, who was the Federal Reserve chairman in the early 1980s and who decided to raise rates dramatically to tame inflation successfully. Also engender the meaningful slowdown, right? I think you have to believe what central bankers are telling you. Their priority is very much to bring inflation down. They have to. It's not really a choice. Inflation has been running at a multiple of targets. Targets are by and large 2% everywhere, or at least in developed markets. Inflation has been running at a multiple of that for a number of months. And rates are still, either, where they were a year ago, just after COVID, or they have just started to raise them. Again, I'm looking at the Fed. Some other central banks in emerging markets are further ahead in the tightening cycle. So they have to, and I think you have to believe them. Now, there is, of course, the chance that if something goes majorly wrong, either, a sharp economic slowdown or a sharp increase in the unemployment rate, or some unforeseen catastrophe that is impossible to forecast today, it's possible that any of those events might force them to slow down or perhaps even stop. But I think the bar is really quite high. The market has drawn the same conclusion. Very interestingly, if you look at what is priced by markets, this very steep, very fast tightening cycle was priced even before they started to raise rates, even before the first hike. So I think we need to believe that that is going to be the case. And of course, the question is, what can asset markets withstand, and what else is going to move as a reaction to that?
Fantastic. Finally, bringing all of these thoughts together, Stefano, how has all of this changing economic and market backdrop informed you and the team in positioning client portfolios currently?
So we have been positioned in a more defensive way, on and off, I will say, since mid-January, we've been either underweight equities, except for when we tried successfully to capture a tactical bounce after the Ukraine invasion. But now we're still running a portfolio that is underweight equities, underweight government bonds, and therefore overweight cash for lack of alternatives, right? So I think what we need to do in an environment like this is to remind ourselves that, of course, we try to achieve our investors' objectives and goals over the medium to long term. But in the current environment, we are much more likely than we might have been over the last year or year and a half to have to change the portfolio allocation a bit more often, simply because there are many very important moving parts that are subject to potentially quick changes of pace or direction. Think about the tightening cycle, of course, not just the Fed, the Bank of England, the ECB. How quickly and to what level, and what they're going to do with the balance sheet. So those are key questions. The situation in Ukraine remains fluid. The markets, to some extent, have gotten used to this risk, to this lingering risk, because it has been just over 2 months. But nonetheless, things could change quickly on the ground and or in terms of the involvement of other countries. There are supply chain disruptions that are not fully resolved. These things take time to resolve. You're talking about building capacity or producing more commodities or more goods. Again, it's not something that you can switch on and off. You could for a full digital company. So putting all of that together, I think we want to ideally put together a string of tactical adjustments until we get more clarity, right, on the overall picture that will allow us to compound and produce returns for our investors.
Brilliant, Stefano. I appreciate both your insight and obviously your views. As a reminder, the views that you hear on this podcast are the views of Santander Asset Management UK and do not constitute individual or financial advice. If you want to explore more of our views and insights, please visit our website at santanderassetmanagement.co.uk. Thanks for tuning in to our latest podcast. We look forward to speaking to you again soon.